Hey, what's up guys? Welcome back. So a highly requested video today. A lot of you have been asking me to do a deep dive on options trading. Now, before I begin talking about options though, I have to warn you that options trading can be extremely risky. And usually I don't recommend options trading for beginners at all. So in fact, in my opinion, 90% of all investors should be nowhere near options just because of the aforementioned risks that I just talked about. So if you browse around on places like Wall Street Bets, in case you don't believe me, you'll see people getting absolutely wrecked. I mean, I've seen people lose like hundreds of thousands of dollars just within a span of like a few days on bad options bets. However, I've also seen people make hundreds of thousands of dollars in just a short span of time with options, but I think at that point you're just like gambling, you're not really investing anymore. But in case you're one of those guys that like to gamble, this might be the video for you. I mean, like, don't put too much money into this, but it's kind of fun to have some fun with options sometimes. So I've heard this story where this guy on Robinhood, I'll link to the article down below if I can find the article, but this guy on Robinhood, he took $15,000, turned it into $1 million, and then lost it all within a matter of a few months. I mean, could you imagine the roller coaster ride on that, right? That's absolutely insane. So let me just tell you guys that this type of ride is not possible if you're just trading stocks. Of course, this is the kind of power that options have, and this kind of ride is only possible if you're trading options. So, you know, since we have this crazy but powerful tool at our disposal though, many people are naturally curious. So today, I kind of want to first explain what options are, so explain the basic features of what options are, and I'm going to go through some of the benefits of trading options or some drawbacks as well. And I'm going to compare it to trading stocks, right? I'm going to answer the question on why would you want to buy options instead of just buying the shares. And then lastly, I'm going to go over some of my own options positions that are open right now and what are my thought processes behind some of them and why I made those options bets. So this should be a very interesting video, and without further ado, let's jump in. Okay, so before I begin, I'm going to ask for an early like on this video. You know, usually I ask for the like at the end of the video just because how do you know if you like the video if you haven't watched the entire thing, right? But I have a feeling that this video is going to be super long already and it's going to take me a ton of time to edit. So I would appreciate the early like on this button, and I'm going to make a rare exception to my rule just so that it helps out with the YouTube algorithm. Anyways, let's begin. So first of all, what is an option though? So an option is the right but not the obligation to buy or sell a stock at a given price on or before a given date. Wow, so that was a mouthful. So go ahead and rewind the video if you want to hear it again. But what does this mean though? Well, let me explain this through an example / analogy, which I think will be the easiest way for me to explain this. So pretend you go to a store and let's say that you see a laptop on sale for $1,000. And let's say that, you know, the regular price of that laptop is $1,500. Now, right now it's $500 off. So let's say you need a laptop really badly and you decide to buy it. So when you go ahead and buy it, however, you go to the clerk and the clerk tells you that it is out of stock and a new shipment won't arrive until next week. But you know that the sale ends today, so by the time that the new shipment arrives, then the price will have gone back up to $1,500. So in these scenarios like these, sometimes stores will issue what's called a rain check. So a rain check is basically a piece of paper that gives you the right but not the obligation to buy the product at the sale price if you wanted to. So let's say the clerk gives you a rain check, and on the rain check, there will be like a price written on the rain check that says $1,000, which is the sale price, and also there will be an expiry date on the rain check because you know, at some point it can't stay valid forever, right? At some point it expires. So you can't just come back like a year later and be like, you remember that sale that we had a year ago? I want to redeem this rain check for that sale that we had a year ago. No, it doesn't work like that, right? They expire. And let's say that sure enough, the sale is over and the price of the laptop goes back to $1,500. Well then, assuming that your rain check hasn't expired, you can pull it out and be like, here, I want to redeem this rain check. So then, you know, if you redeem the rain check, then you have the right to buy the laptop for $1,000, even though that the price has gone back up to $1,500. So when it comes to products, these things are called rain checks. When it comes to a stock though, these things are called call options. So you can think of a call option as a rain check on a stock. So back to the laptop example, the $1,000 sale price, the price that is written on the rain check is called the strike price when it comes to a call option. So the strike price is the price that you can buy the stock for if you have that call option And expiry dates work pretty much the same way. They expire at some point. So notice how a call option gives you the right to buy the stock on or before a given date at a certain price. So notice how in the laptop example though, going back to the laptop example, you didn't need to redeem that rain check if you didn't want to, right? Let's say you change your mind. And let's say that while you were waiting for the new laptop to come in, you change your mind and you don't want it anymore. Well, you can just never redeem the rain check if you so chose, right? So remember the definition, an option is a right but not the obligation. So you're not obligated to redeem that call option if you don't want to. Alternatively, what if you sold the rain check to someone else? Now realistically though, they would write your name on the rain check to prevent exactly this, to prevent you from like selling it. But let's say that for this particular store and for this particular product, they didn't write your name on it and you could sell it. Well, how much could you sell this rain check for? Well, in this case, your rain check might be actually worth a lot of money, right? Because if someone else was looking for a new laptop, they can buy the rain check for off of you for let's say $100 and then they can redeem it. So then basically they got a $1,500 laptop for $1,000 plus the $100 that they paid you to buy the rain check. So they bought the $1,500 laptop for $1,100. So they save $400, right? So it might be a good deal for them to buy that rain check off of you. So if you think about it though, how much should this rain check actually be if you were to sell it? Well, it should be worth like $500, right? And that's because at that point, it will be worth the same as you just buying the laptop for $1,500 or buying the rain check for $500 and then spend another $1,000 to redeem it at the strike price, right? So you'll be indifferent between these two choices. So the rain check should theoretically be worth $500. We call it exercising, by the way, when you redeem a call option. So we don't call it redeeming, we call it exercising. So if you exercise the call option, then you redeem the stock at the strike price. So substitute the terms. Pretend instead of a laptop is a stock. Now we say that this is the underlying stock. So pretend is your favorite stock like Tesla or something. We call it the underlying stock or the underlying asset. And instead of a rain check, we call it a call option. And instead of the sale price, again, we call it the strike price. And expiry date is just expiry date, right? That stays the same. That's pretty self-explanatory. So to summarize the components of options, we have number one, what the underlying stock is. Number two, what the strike price is. Number three, what the expiry date is. And number four, how much the option is trading for, right? Like how much can you actually buy the option for? And one more thing to know, options are sold in what's called contracts. And each contract is 100 options. So with this in mind, you always have to buy and sell options in multiples of 100 just because you have to buy them and sell them in batches of 100. You have to buy and sell in contracts. Now for a more concrete example though, I'm going to show you a real life example of information that you can obtain on an option. Now I'm going to use RBC Direct Investing just because I do like the way that they lay out this information. So in case you're wondering about the platform that I'm using, it's RBC. And yeah. Anyways, you're looking at a call option right now for Tesla stock. And notice that the name of the option is indicative of what it is, right? So you'll see the ticker for the stock, for the underlying stock, obviously, which is TSLA, Tesla in this case, and the number that is the expiry date. So you'll see that it says 01/15/21, which is the expiry date, i.e. January 15th, 2021. So we'll have about 3 months or so left to go before this call option expires. And then we can see that the strike price is $450 and the C stands for call. So indicating that it's a call option, right? So if you were to buy this option, you have to pay the ask price, which is the price that you see there highlighted right now, which right now is sitting at $60.10. Now remember, this is the price per option. So as I mentioned earlier, you have to buy and sell options and contracts. So the least you can buy is one contract, which is 100 options. So then each contract would be $6,010. So just multiply that ask price by 100. And also on the right, you can see that RBC has displayed the payoff graph and also the break-even price. So the break-even price would be the strike price plus what you paid for on the option. So for example, if the shares were at $500 and let's say the strike was at $450, well, you could exercise your option and buy a share for $450 and then sell it for $500, right? So you bank $50. However, remember you paid $60.10 per option. So all in all, you would have actually lost $10.10 per share or per option, or just around $1,000 per contract. So just because that the stock is trading for higher than the strike price doesn't mean that you're more than your break even, right? You could still lose money. So you'll notice in this case that with Tesla shares, if the price of Tesla is above $510.10 per share, by the time the expiry date rolls around in January, you'd make a profit in total. Now, of course, no one says that you have to hold options till expiry, right? In fact, I would recommend that most people don't hold options to expiry. And yeah, that complicates things if you don't hold options to expiry. So the break-even price is just like the average amount of money that you spend per option, right? But yeah, most of the time, if you hold options, you should consider selling if you're up big, just because of reasons that I'm going to mention a little bit later. Anyways, so that was an example of a call option though, and you can make money on the option when the underlying stock goes up if it's a call, right? So also the opposite of a call is called a put option. So a put option is a right to sell an asset, in this case a stock, at a given price on or before a given date. So, if a call option is like a rain check, you can kind of think of a put option as sort of an insurance policy. So you can buy a put option on a stock that you own yourself to protect yourself against downward risk of the stock dropping, right? So if the stock drops really huge, then you can exercise your put option and sell the stock that you have at a higher price than what it is trading for on the market, right? So it's kind of like an insurance policy that you can buy. Also, you can buy put options on stocks that you don't own, which in this case will be an option to bet that the stock goes down instead of actually shorting it. So you can actually make money when the stock goes down without shorting the stock. So that's another use case for put options, where you can bet that a stock goes down in price. So now let me show you an example of what a put option looks like with Tesla once again, with the exact same strike and expiry date, but on the put side, obviously. So here it is. And remember that you have the right to sell a stock at the strike price when it comes to a put option. So, if the price of Tesla goes down, then your put will be worth more, since you can buy a share of Tesla for cheap on the open market and then sell it for a higher price when you exercise your put option. Now finally, I want to talk about how options are priced though. So there are two components to options pricing: the intrinsic value and the time premium. So intrinsic value is just what you would profit if you exercise your option right away. As in, let's say you had a call option for Tesla at a strike of $400, and let's say that Tesla shares are now at $500. Well, if you exercise your option right now, you can buy a share of Tesla for $400 and then sell it for $500 immediately. So the intrinsic value of the call option would just be 100, right? It'd be the difference between the strike and what the shares are trading at right now. Alternatively though, let's say that the strike price is still at 400, but the stock is trading at 350. Well, then you don't want to exercise your call option in this case, right? Because why would you buy a share of Tesla for $400 using your call option when you can just buy it on the open market for $350 for a lower price, right? So in this case though, the intrinsic value would be 0, right? Because the option is not worth anything because there's no intrinsic value. So by the way, options with positive intrinsic value, i.e. above 0, is called in the money, right? So we say that an option is in the money when there is intrinsic value. So options that have no intrinsic value is called out of the money. So essentially they're like worthless if they expire, right? So there will still be some worth to the option because of the time premium that we're going to talk about very soon, but the intrinsic value part is 0 if the option is out of the money, meaning that for a call, the strike is higher than the price that the stock is trading for right now, and for a put is the opposite, right? So yeah, once again, this is what makes options kind of risky potentially, because if your options are not in the money, by the time the expiry date rolls around, they become worthless, right? So you would lose 100% of what you put into the option when you bought the option. So compare this to shares though. The reason why options are more risky than shares is because shares, they will like almost never go to 0, right? They will only go to 0 if the company that you invested in goes bankrupt, which, is pretty rare, and it happens a lot less often than options expiring out of the money. In fact, most options expire out of the money. So options expire out of the money all the time, whereas in order for you to lose 100% of your investment into shares, then you have to pick a really bad company that actually goes bankrupt. But wait, there's more. So I mentioned earlier that there's also a time component when it comes to options pricing called a time premium. And this is just because that the further away the option is from the expiry date, the more the option will be worth. So the easiest way to think about it is that consider if you have two options, right? And everything else is the same about the option except for the expiry date. So pretend that the underlying stock is the same and the strike price is the same. Everything else is the same except for the expiry. So let's say one option expired tomorrow and one option expired a year from now. Which one do you think will be worth more? I think that the option that expires a year from now should definitely be worth more, right? Because let's say you're out of the money. So then, if your option expires out of the money, then it's worthless, right? So if you have a longer dated option, then you have more opportunity for the stock to go where you want it to go. And even if you're in the money, then the option could fluctuate even more and go up even more in that time, right? So that time that you have until expiry is worth something, and then that worth something is called the time premium. So the point is that the time leading up to when the option expires is worth something, and that something is called the time premium, and the longer you have until the option expires, the more you have to pay to get that option. And notice how as we draw closer and closer to the expiry date, the value of the option goes down, right? So therefore it lowers the price of the option, and this is called time decay or theta decay. And this is why it's not recommended to hold options for too long, is just because of time decay. And I love how it's called decay because it's so accurate, right? Because if you hold options for too long, they start rotting in your hands, literally. So lastly, I also want to make a note about another thing that affects options pricing a lot, which is volatility. Now, the more volatile a stock is, the more expensive the options will be. So an easy way to understand this is considering something like a Tesla versus, let's say, a Coca-Cola, right? So it's really not out of the ordinary for Tesla to go up and down by like 10%. Without any news, right? So it would be very difficult though for Coca-Cola to go up and down by 10% without any news, unless some sort of crazy event happens, right? Where some like news specifically about the company came out. But in general, we can kind of all agree probably that Tesla stock is a lot more volatile than Coca-Cola. So logically then Tesla options should be more expensive than Coca-Cola options just because there's more opportunity for you to make money in Tesla options just because of how much the underlying stock moves. And volatility is something that a lot of beginner investors miss when they first jump into options, and this is because they think, oh, if I buy a call option, all I have to do is wait for the underlying stock to go up and then I make money, right? Well, not so fast, not necessarily, because if you bought the stock when volatility was really high, let's say some news about the company came out or some earnings report was, let's say, really good in the case of a call option, and then you bought the call option because like you think that the stock is going to run up even higher after the earnings. Well, let's say for example the earnings report news kind of died down and then people kind of forgot about it, and then the stock starts slowly still trending up, but trending up very slowly. You can still actually lose a lot of money even though that the stock is moving up, and you wonder why am I losing money when the stock is moving in my desired direction? Well, it's because volatility went down. So the options premium, the volatility premium goes down, and this is called IV crush in like options trading lingo. So yeah, a lot of people, a lot of beginners especially, they get killed by IV crush just because they don't understand that volatility drives options prices. So anyways, that was a very long-winded explanation, and I'm going to leave the explanation here for now. Right now, I want to go through why you would want to potentially trade options instead of just buying the shares. And the main reason is leverage. So recall I mentioned earlier that options are sold in contracts, which each contract contains 100 options. You'll find that buying a contract, i.e. 100 options, will give you control of 100 shares, which will actually cost a lot less than actually buying 100 shares. So for example, in the Tesla example I showed earlier, if you were to buy one contract of those call options at a strike price of $450 that expire in just about 3 months, this will cost you just over $6,000 US. But actually buying 100 shares of Tesla at today's closing price will cost you $43,967. So, if you buy the options instead of buying the actual shares, that gives you like a 7x leverage. So in simpler terms, this means that for every $6,000 you spend on calls, you can get the same upside as if you spend around $44,000 or so on shares. But keep in mind the downside of buying options, which is that you are time limited. So obviously, as I mentioned earlier, you have 3 months until the options expire. So if the options are not in the money, right? So if the options are out of the money by the time that they expire, well, then they expire worthless, and then you lose 100% of what you put into the options. So shares you can hold for as long as you want, once again, right? So shares don't expire. So the second reason why you will want to buy options instead of just buying shares is for use in hedging strategies to actually reduce your risk. So there are strategies and payoff curves that you can construct with options that will actually reduce your risk in the stock market. Now, we're not going to talk about those today because it gets quite involved and some of these strategies can get quite complicated. So I'll save that part for another video, and let me know if you guys want to see that other video on options strategies. But I do, however, now want to go through some of my own options positions and go through some of my thought process on why I chose to buy these particular call or put options or whatever, right? I only have calls right now. I don't have any puts. But yeah, anyways, I don't have a lot of options position open right now, and this is just because I prefer to invest in stocks most of the time, just because I'm not bound by a time limit if I just invest in stocks. But anyways, let's get the bad news out of the way first. So my first options play that I have right now is one contract on SLV, which is the iShares Silver ETF. So basically it's tied to silver prices. They have like this vault of silver somewhere, and they issue shares of that silver based on what's in the vault, right? So it tracks silver prices, and basically these are March 21st, 2021 calls with a strike of $23.50, and currently I'm down about 40% on this position, which sounds really bad, but it's not really a big position anyways. I only put like $400 or so into this in the first place, but still, percentage wise, I'm down by quite a bit, and this is the risk obviously that you have to take with options. So basically I bought this back when silver was running up big a couple months ago, and honestly I thought that silver prices were going to go a lot higher than they actually did. Also, I was kind of counting that the US government will pass a second stimulus bill, which in theory should help with gold and silver prices. But I guess I put too much faith in the American government. So I learned my lesson the hard way, and I'm paying the price for it. But I did promise I show you guys both options or positions in general that I'm up big on or down big on. So I'm not a prophet, obviously, so I could be wrong, and in this case I was, and I'm gonna have some losers from time to time. So no one can be right on absolutely every single trade, and certainly I wasn't on this trade. And I'm not like one of the guys that try to hide all their down positions, all the positions that they lose money on. And you know, if I'm down big, I show you guys, and then maybe we can talk about it and actually discuss where things might have went wrong, and maybe we can actually learn something from it, right? So yeah, that's not the most ideal position that I'm in for my SLV calls, but hey, it is what it is, right? That's the name of the game. It's an occupational hazard when you're an investor. So moving on to a better position though, I have two call option contracts on Slack Technologies, ticker symbol WORK. And these expire in January 2022, and the strike is at $27, and I paid an average of $7 per option. So as you can see right now, this one I'm actually up pretty big on. I'm up around 50% on it, and this position is turning out pretty well if you ask me. So yeah, I already went through my bullish thesis on Slack, and I talked about buying the calls when I bought them, so make sure you check out that video if you haven't seen it already. And yeah, so far these are my only two options play at the moment, SLV and WORK. And again, I don't want to go too heavy into options just because of the risk, right? I kind of just dabble in options. Like I don't bet my entire account on options or anything like that. I know when you look at the Slack calls I just showed you, it says that it's like 80% of my portfolio or something. And that's just because I use my Questrade account almost exclusively for these like reckless options bets. So yeah, it's kind of like, again, my fun account. So I don't have like that much money in that account, at least not compared to my RBC account, which is my main account. So if you're wondering why it's like 80% of my portfolio, that's why. But I don't actually have 80% of my entire portfolio in like Slack calls. Don't get me wrong, I still believe in Slack, but that would be quite a risky move that I'm not willing to take at the moment. So anyways, I'll leave the video here because it's getting super long, and be sure to hit the like button if you enjoy the video, because it'll probably take me a long time to edit this video because I can tell it's already super long. But yeah, be sure to hit the like button, and be sure to consider subscribing if you like this series. And be sure to follow me on Twitter and Instagram. I'll leave the links down below in the description as always. And with that being said, I'll see you guys in the next video. Bye bye!